Welcome to TalkTickers.
Glad to be here.
Today, we're taking a deep dive into Enviri Corporation's Q1 2025 earnings call.
That's right. We've gone through the commentary, the numbers.
And our mission, as always, is to pull out the key insights for you, give you that clear picture of how they did and what might be coming next.
Without you having to sit through the whole call.
Exactly. So let's kick off with the overall performance. It looked like a bit of a mixed picture initially.
Yeah, you could say that. Enviri's first quarter, well, it showed some real strength in parts, but also faced some headwinds elsewhere.
Okay.
Overall revenue was down slightly, about 4% organically. If you adjust for things like, currency changes, divestitures, and some rail contract adjustments.
Right. Those adjustments matter.
They do. But when you look segment by segment, Clean Earth was the real standout.
Heard that name pop up. Double-digit earnings growth.
Exactly. Double-digit growth, even with the steel market being tough globally.
Impressive. What about the others?
Harsco Environmental actually did better than their own internal targets. Rail financials were soft, which wasn't unexpected.
Right. They flagged that previously.
They did. But the big news there was renegotiating a major contract successfully. Plus, they're building up their backlog.
Positive signs for the future then, maybe?
Potentially, yeah.
Yeah.
And importantly, the environmental segments, Clean Earth and Harsco, showed good stability. Organic revenue and adjusted earnings were basically flat despite some site closures.
Mm-hmm.
And Clean Earth, specifically, had record first quarter results.
Wow. Yep.
Cash flow is also better than they planned, which lets them stand by their full-year cash flow guidance.
Good to hear. Any other key highlights from the overview?
Yeah, they completed the leadership rebuild in the rail segment. New president, new CFO.
So fresh eyes there. Let's talk numbers quickly.
Yeah.
Revenue was
$548 million total. Adjusted EBITDA came in at $67 million.
And that was hit by FX and divestitures.
Yeah, about $7 million impact there. Adjusted diluted loss per share was 18 cents, but that excludes special items.
Special items like Hicks.
Like an $11 million favorable adjustment in rail from that Deutsche Bahn contract amendment we mentioned.
Oh, okay.
And also about $5 million in project and restructuring costs.
Got it. And free cash flow.
Adjusted free cash flow was negative $13 million for the quarter.
Which sounds bad, but you said it was better than expected.
Right. Better than planned, mainly thanks to Harsco Environmental's performance holding up.
Okay, so let's dig into Clean Earth first then. You said it was the standout. What's behind that? Margins improving significantly.
Yeah, that's the key part of the story. Margins grew by over 100 basis points. They're now exceeding 16%.
That's quite a jump.
It is.
Yeah.
Especially, given the general economic noise.
Mm.
Suggests good pricing power or maybe just really strong operational efficiency.
Mm-hmm. What are they focusing on strategically?
It seems to be expanding their services, growing the business overall, and really focusing on customer service.
And it's working.
Looks like it. They mentioned investments in their commercial teams are paying off. They've got a robust business pipeline.
Okay. Is the growth coming from price or volume?
A balance of both, which is pretty much what they expected.
Makes sense.
And operationally, they're still pushing for efficiency. They're investing in this unified IT platform. They expect that to improve productivity down the line.
This One Clean Earth initiative.
That's the one. They think it'll drive significant savings in SG&A eventually, plus other efficiencies from, better routing and disposal methods.
So the outlook for Clean Earth sounds pretty bright then?
Definitely. Positive on earnings, margins, free cash flow. It's really outpacing the other segments and hitting above their previous targets.
And management expects volume to pick up more this year.
Yeah, they specifically said volume should be a bigger driver of earnings growth this year compared to the last few.
Interesting. Are they seeing any signs of an economic slowdown hitting them yet?
Apparently not. They mentioned no impact on customer activity or spending so far.
Okay, quite resilient then. Now, let's shift gears to Harsco Environmental. Sounds like a tougher story there.
Yeah, it definitely is. They're right in the middle of that difficult period for the global steel industry.
Oversupply, weak demand.
Exactly. That's the backdrop. Steel prices have recovered a bit, and their customers are a bit more profitable, but service volumes are still low.
No sign of idle capacity restarting?
Nope, not that they've observed. They're hoping trade protections might help, especially in Europe, which is their biggest market.
Right.
And interestingly, a weaker U.S. dollar could actually be a positive for them.
How so?
Well, about 80% of their revenue comes from outside the U.S. So when the dollar was strong recently, that actually hurt their reported revenue and EBITDA. A weaker dollar reverses that.
Ah, okay. A potential tailwind then. So what are they doing about the tough market?
Being pretty aggressive on cost control, managing capital spending tightly, cost reduction programs, pushing operational improvements at their sites.
Trying to maintain profitability while they wait it out.
Essentially, yes. Maintain profitability, support cash flow, and wait for the steel market to turn.
And how are volumes actually looking at their customer sites?
On a continuing site basis, steel production was only down less than 1% year over year.
Oh, okay. Not too bad.
Yeah, and their own service volumes and earnings at those specific sites were actually up slightly.
So some underlying stability there too?
Seems so.
Yeah.
They expect the second half of the year to be stronger.
Why is that?
A few reasons. New sites ramping up, comparisons getting easier year over year because of sites they exited previously, and just ongoing operational improvements kicking in.
Okay, makes sense.
Yeah.
Let's turn to Harsco Rail. Soft financials, you said, but that Deutsche Bahn contract news sounds significant.
It really is. While the demand for their standard stuff, equipment, parts, services that remain strong with healthy orders in Q1, the big development was amending that major ETO, or engineered to order contract with Deutsche Bahn.
Custom build stuff, right?
Exactly. This amendment is huge because it tackles the cost inflation they were facing, revises pricing, and sets a more, let's say, realistic delivery schedule.
De-risking the project, basically.
Precisely. And it resulted in that favorable $11 million accounting adjustment this quarter.
Okay. How's the actual work progressing?
Prototype development and testing are going well, apparently.
Yeah.
They expect the final approvals homologation later this year or maybe mid-Q3 next year.
So still some hurdles, but moving forward, what are the remaining risks on these big ETO projects?
Mainly around the final testing and getting customer acceptance for those initial vehicles. The first one is built and being commissioned now.
Right. And you mentioned new leadership.
Yeah. New president, Gary Lutta, plus new heads of finance and operations.
Yeah.
Strengthening the team.
What's their immediate focus?
Removing operational bottlenecks, getting a better handle on the supply chain, and just pushing these ETO contracts forward.
And the core rail business.
Still profitable, still generating cash. They have a strong reputation there. The full year outlook for rail anticipates things improving operationally in the second half with higher throughput.
Okay, so putting it all together, Clean Earth strong, Harsco navigating headwinds, rail working through contracts. What's the overall guidance look like now for Enviri?
They actually reaffirmed the full year guidance for the company and for each segment. No changes there.
So still targeting.
Company EBITDA between $305 million and $325 million. And free cash flow projected at $30 to $50 million for the full year.
Did they mention any potential upside?
They did acknowledge that Q1 being strong plus the weaker U.S. dollar, if that continues, could offer some upside potential.
With caveats.
Yeah, the usual caution about economic uncertainty making visibility into the second half a bit limited.
Understood. What about Q2 specifically?
They gave a range for Q2 adjusted EBITDA, $65 million to $75 million.
Okay. And segment-wise for Q2?
They expect Harsco Environmental results to be below last year, similar to Q1, because of those divestitures and site closures.
Right.
But Clean Earth is projected to improve year over year again in Q2, thanks to both price and volume.
Good momentum there continues.
Seems like it. And Rail's adjusted earnings in Q2 are expected to be pretty similar to Q1.
Okay. And Q2 cash flow.
Expected to be negative again.
But looking further out.
They anticipate lower net outflows on those rail contracts and lower pension contributions, helping them get back to positive cash flow in the future years. They're targeting $150 million in annual free cash flow consistently once those big ETO contracts are finally done.
A longer-term goal then. One last area. Tariffs and global trade.
It's a messy picture out there.
Yeah.
How does that impact Enjo?
Well, being so diverse across markets and geographies, it's kind of a mixed bag for them, right? Both potential benefits and challenges.
Like what?
They mentioned operations in Mexico and Canada could feel the pinch from U.S. tariffs. But on the flip side, EU actions to support its steel industry, that could actually help Harsco Environmental.
Right. So swings and roundabouts.
Pretty much. They acknowledge the macroeconomic uncertainty from all these trade issues could slow things down eventually.
But are they seeing a direct hit right now? They said that at this point, they don't think the direct tariff impact is material. And more importantly, they haven't seen any meaningful shift yet in their underlying business or customer behavior because of it.
Okay, watching brief, basically.
Yeah, definitely monitoring it closely.
All right, let's move to our final segment where we put on our speculative thinking caps. This is not financial advice. Based on everything we've just discussed, what's an interesting, maybe unconventional trade idea that pops out.
Okay, well, look, given how consistently Clean Earth is performing, especially those expanding margins, and their focus on that one Clean Earth IT initiative, here's a thought. Instead of just focusing on Enviri, maybe consider companies that specialize in, say, AI-powered sensor technology, specifically for waste management and environmental monitoring.
Interesting. So the tech behind the efficiency drive.
Exactly. Think about the enabling infrastructure. If Clean Earth and likely its competitors are all pushing for IT-driven optimization, they'll probably need more sophisticated ways to gather real-time data, right?
Makes sense. Data on waste streams, environmental conditions, operational stuff.
Precisely. So this is a bet that the demand for that kind of advanced data collection in the environmental services sector itself is set to grow significantly.
Kind of a picks and shovels play on the sector's efficiency trend.
You could put it that way. While Enviri's doing well, investing in the tech providers, the ones making those sensors and analytics tools, might capture a broader wave.
What's the risk there?
Well, the main risks are that Clean Earth or others might develop this tech in-house, or they might partner with less specialized, maybe cheaper providers. But with increasing complexity regulations, the need for really cutting-edge dedicated sensor tech seems like a potentially strong, though definitely speculative angle.
A fascinating idea focusing on the enabling tech. Okay, that wraps up our deep dive into Enviri Corporation's Q1 2025 earnings call.
We've covered quite a bit: the results, the segment performance, the outlook.
And that speculative trade idea. Hopefully this breakdown has given you some valuable insights.
Yeah, we trust it helps clarify the key drivers and maybe the potential direction for Enviri. But as always, please remember this is for informational purposes only.
Absolutely. Do your own thorough research before making any investment decisions. What stood out most to you from this call? We'd genuinely be interested to hear your thoughts.
And maybe something to ponder. With Clean Earth consistently being the engine here, could we see Enviri evolving, perception-wise, to be viewed primarily as an environmental services company down the road?
That's a really interesting point to consider. Definitely food for thought. Thank you for tuning in to TalkTickers.
We look forward to unpacking another key earnings call with you next time.